Hi, Assalamualaikum. We from Group 2 want to present about analysis of cooperative financial performance. In this assignment, we choose Gamuda Berhad and IJM Corporation Berhad as our company project. Before we start, this is my group members. Okay, first of all, I want to talk about the background of Gamuda Berhad. Gamuda Berhad was incorporated on 6 October 1976 in Ipoh, Perak. It was listed on the list of Bursa Malaysia Board in 1992. The company headquarters is located in Petaling Jaya, Selangor. It was founded by Kun Yu Yin and Lin Yun Lin. Gamuda's core business sector include engineering and construction, property development, infrastructure and concession, with a strong focus on innovative and sustainable infrastructure solution.
In this slide, I will present about background of IJM Corporation Berhad. IJM Corporation Berhad is one of Malaysia's largest diversified company, known as conglomerates, with the core businesses of construction, property development, industrial manufacturing, and infrastructure sectors. The company was created as a result of the combining of three very reputable construction companies in 1983, which is IGB Construction Sendirian Berhad, Jurutama Sendirian Berhad, and Mundajaya Sendirian Berhad. With the mergers, IGM had the ability to take on larger, more complex projects, and those has grown rapidly in the Malaysian construction market over the years. IJM listed on the Bursa Malaysia in 1986. This provided better access to the capital, which has helped IJM expand, furthering the company with greater visibility within the marketplace. In 1989, the name changed from the original three names to IJM Corporation Berhad. IJM expanded locally and internationally, especially when it acquired the group in 2007. Currently, IJM is a recognized leader in delivering major infrastructure projects, developing sustainable township, managing high-value industrial operation, concession-based assets, holding management contracts for several major infrastructure and industrial companies. Now headquarters in Petaling Jaya, IJM continues to fulfill its role as a major contributor to Malaysia economic and developments. IJM vision is to become a leading Malaysian conglomerate in the market we serve, and their mission is to deliver sustainable value to our stockholders and enrich life with the IJM mark of excellence.
I will present the profitability ratio of Gamuda Berhad Company. The profitability ratio divided to 5. First, gross profit margin, operating profit margin, net profit, return on asset, and last, return on equity. First, gross profit margin. Gross profit margin shows the percentage of profit from sale after deducting the cost of goods sold. The gross profit margin from 2020 to 2024 shows that the company profitability was unstable. In 2020, the margin was moderate at 36.97%. In 2021, was 56.89%, showing better cost control. However, in 2020, the margin dropped to 42.93%, indicating higher cost or lower efficiency. In 2023, the margin rose sharply to 77.02%, reflecting strong performance. But in 2024, it fell drastically to 8.86%, suggesting a major increase in cost or lower selling price. Next, operating profit margin. Operating profit margin is the percentage of profit a company earns from its core business operation after operation expense. This graph shows the operating profit margin from 2020 to 2024. In 2020, the operating profit margin was 45.01%. In 2021, the margin increased significantly to 59.65%. However, in 2022, the margin dropped to 32.94%, which may indicate higher operating expense or lower operating profit. In 2023, the operating profit margin recovered to 38%. Finally, in 2024, the margin declined sharply to 11.67%, suggesting a significant decrease in profitability and possible operational challenge. Next, net profit margin. Net profit margin shows the company profitability after all costs. In 2020, it was 15.60%, a moderate level. It increased sharply to 50.72% in 2021, the highest in 5 years. In 2020, it declined to 31.49%, then rose again to 39.17% in 2023. However, in 2024, it dropped significantly to 4.44%, showing much lower profitability. Next, return on asset. The graph shows the company return on asset from 2020 to 2024, which reflect how efficiently the company used its asset to generate profit. In 2020, the ROA was relatively low at 2.11%, but it increased significantly in 2021 to 8.94%. However, in 2022, the ROA declined to 4.83%. In 2023, the ROA improved strongly to 13.78%, showing excellent financial performance and effective asset management. Lastly, the ROA dropped sharply in 2024 to 1.26%. Last, return on equity. Return on equity shows how well the company used shareholder fund to generate profit. In 2020, the ROE was 3.86%. It increased to 13.60% in 2021, showing improved performance. In 2022, it declined to 7.66%, and the ROE rose strongly to 23.35% in 2023. However, in 2024, it dropped sharply to 2.33%, showing much lower return.
Next, we move to asset utilization ratio. This slide shows the receivable turnover ratio, which measures how efficiently the company collects money from its customer. A higher receivable turnover means the company is able to collect payment faster. Based on the data from 2020 and 2024, the ratio shows an overall increase, especially in 2023 and 2024. This indicates the company has improved its credit management and cash collection efficiency over the years. The second one is average collection period, which shows the average number of days the company takes to collect payment from customer. A shorter collection period is better because it improves cash flow. From the trend show, the collection period decreased in recent years, especially in 2023 and 2024. This means the company is collecting its receivable faster and managing its asset more efficiently.
Inventory turnover shows how a company sells and replaces its inventory over a period. It is calculated by sales dividing an inventory. A higher inventory turnover indicates faster inventory movement and efficient inventory management. The inventory turnover ratio increased significantly over the years. In 2020, the ratio is about 1329.41 times. It rises to around 2959.74 times in 2021 and 2771.66 times in 2022. In 2023, the ratio increased sharply to about 7186.30 times. In 2024, it reaches approximately 27569.15 times. This shows that the company is selling and replacing its inventory much faster each year.
Fixed asset turnover shows how efficiently a company uses its long-term debt asset to generate sales. It's calculated by dividing sales by fixed asset. A higher ratio means the company is using its fixed asset more effectively. In 2020, the ratio was 7.72 times, indicating moderate efficiency in using fixed asset. The ratio increased significantly to 13.78 times in 2021, showing better utilization of fixed asset. In 2022, the ratio dropped 9.31 times, suggesting less efficient use of fixed asset. The ratio improved again in 2023 to 12.12 times and further increased to 14.43 times in 2024. Overall, the trend shows that the company's use of fixed asset improved over time, especially after 2022. Next is total asset turnover. It shows how efficiently a company uses its asset to generate sales or revenue. It is calculated by sales divided by total assets. From 2020 to 2021, the ratio increases from 0.13 to 0.19 times, showing an improvement in asset efficiency. In 2022, the ratio slightly decreased to 0.19 times, indicating slower asset utilization compared to the previous year. The ratio is peak in 2023 at 0.35 times, suggesting a strong improvement in how assets were used to generate sales. In 2024, the ratio declined to 0.18 times, but it still remained higher than in the earlier years. Overall, the trend shows that the company's asset utilization improved significantly after 2022, despite a slight decline in 2024.
In this slide, I will present about liquidity ratio. Liquidity ratio have two types, which are current ratio and quick ratio. The current ratio graph shows Gamuda Berhad ability to meet its short-term liabilities using its current asset. If you guys look on the right of the slide, it has the calculation to get the data for the current ratio. So, based on the line chart, the current ratio of Gamuda Berhad in 2020 is 1.34 times, which is the lowest between 5 years. This is indicating a weaker short-term liquidity position. In 2021, the graph rises significantly to 2.07 times. This is reflecting an improvement in the company ability to cover its current obligation. In 2022, there is a slight decline in the ratio from 2.07 times to 1.83 times, suggesting a temporary weakening in liquidity. The ratio then shows a gradual increase in 2023, which is 1.88 times, and rises further in 2024 to 2.3 times. Overall, the shape of the graph indicates that Gamuda Berhad maintains an adequate level of liquidity, with a stronger position towards the end of the period. We move on to the next slide. Quick ratio is to measure a company ability to pay back its short-term liabilities by having assets that are readily convertible into cash. The quick ratio graph shows a trend that is very similar to the current ratio. This is because the company holds only a small amount of inventory. As a result, excluding inventory from current assets does not significantly change the ratio. So, from 2020 to 2024, the quick ratio follows the same pattern as the current ratio, with an increase in 2021, a slight dip in 2022, and a steady improvement in the final 2 years. This indicates that most of the company current assets are liquid and can be readily used to meet short-term obligations.
Next, I will present about debt utilization ratio. It's divided to three. The first one is a debt to total asset. The second one is time interest earned, and the third one is fixed charge coverage. I will explain about debt to total asset first. Debt to total asset measures the proportion of a company asset that are financed through debt and therefore reflects the level of financial leverage and risk. For Gamuda Berhad, this ratio was 45.42% in 2020, declined to 34.26% in 2021, increased to 36.93% in 2022, rose further to approximately 41% in 2023, and increased again to 45.81% in 2024. This trend indicates that while the company reduced its leverage in 2021, it progressively increased its reliance on debt financing in subsequent years. The rising leverage from 2022 onwards suggests a more aggressive financing strategy which may support asset growth but also expose the company to the higher financial risks, particularly in the periods of earnings volatility or rising interest rates. Next, it is time interest earned. Okay, time interest earned measures a company's ability to meet its interest obligations from operating profits and is an indicator of interest payment safety. This ratio was 5.05 times in 2020, increased to 9.46 times in 2021, declined to 5.90 times in 2022, rose sharply to 21.76 times in 2023, and subsequently fell significantly to 1.85 times in 2024. This pattern reflects considerable fluctuation in the company's ability to service its interest obligation, while the very high coverage in 2023 indicates strong operating performance and low financial distress in that year. The substantial deterioration in 2024 suggests increased pressure on the earnings and the heightened risk of financial strain. Next, we have fixed charge coverage. Fixed charge coverage measures a company's ability to meet all fixed financial commitments, including interest and fixed charge, from its operating earnings. This ratio was 6.05 times in 2020, declined to 6.90 times in 2021, rose to 22.76 times in 2023, and then declined to 2.85 times in 2024. This trend demonstrates that although the company was generally capable of meeting its fixed financial commitment in most years, the sharp decline in the most recent period indicates a weakening capacity to cover fixed charge. This may signal emerging financial stress and highlight the importance of maintaining stable earnings and prudent cost and debt management.
Next, I will be comparing the profitability ratio for 2024 of Gamuda and IJM company. First, in term gross profit margin, Gamuda record 90.8% while IJM record 26.91%. Second, for the operating profit margin, Gamuda stood at 11.7% where IJM was higher at 21.50%. Third, looking at the net profit margin, Gamuda earned 4.44% while IJM record a stronger percentage of 11.23%. Next, for return on equity, Gamuda provide a return of 2.33% while IJM show a higher return of 6.51%. Finally, return on asset, Gamuda record 1.26% while IJM achieved 5.49%.
This slide compares Gamuda and IJM across 4 financial ratios. First is profitability. Gamuda is more profitable and consistent than IJM. Gamuda should maintain cost control, while IJM needs to improve efficiency to boost margins. Second is debt ratios. IJM manage its debt better than Gamuda, and Gamuda should reduce reliance on debt to lower interest costs, while IJM should maintain its stable structure. Third is liquidity ratios. Gamuda has stronger liquidity and should continue good cash management. IGM needs to improve its short-term financial position. Last is activity ratios. Gamuda uses its asset more efficiently. IGM should improve project efficiency and speed up receivable collection. Overall, Gamuda perform better operationally, while LGM is stronger in debt management. In conclusion, Gamuda Berhad performed better overall in terms of profitability, liquidity, and asset utilization based on the 2020 until 2024 trend analysis and 2024 comparison. This shows strong operation, efficient asset use, and good cost management. Meanwhile, for LGM Corporation, it has more stable debt position. However, it still has a room to improve profitability and asset utilization through better cost control and operational efficiency.